Just going to give it another couple of seconds to leave some people in from the waiting room. And thanks for everyone who's after joining us. Look, I really appreciate your time on this Friday afternoon. You're all very welcome on the webinar, obviously, which is going to be centered on ways that you can reduce how much tax you pay. My own name is David Looney, and I work as a financial planner with Alpha Wealth. For those of you who might be on this webinar for the first time, just to note, we have been running a lot of these online financial webinars over the last 2 years or so, and they just basically allow people to get, I suppose, free, impartial financial advice from the comfort of their own office or their home. It's usually done over a lunchtime session, maybe on a Wednesday or a Friday, as is today, and we have started doing the odd few evening sessions as well. So just keep an eye on our social media channels if anybody is interested in, I suppose, coming on some, I suppose, webinars on other topics. The next one I'll be running will actually be the 14th of October, so Friday the 14th of October at 1 p.m. And that one is going to be focused on retirement planning. So if anyone is interested in coming on, we can share the registration link with you following today's webinar. So just to kick off, I just wanted to start by giving people a quick introduction to, I suppose, myself and Alpha Wealth, who we are and what we do for those of you who don't know. We basically run a financial services company headquartered in Little Island in Cork. And in simple terms, we basically just provide financial advice to individuals and families and business owners in pretty much all areas of personal finances. So things like savings and investments, mortgages, retirement planning and pensions, protection insurance, tax planning, and, you know, as I said, anything else within that space. We are, I suppose, a central bank regulated company. Currently, we've 8 qualified advisors in Alpha Wealth that have over 60 years of experience between us. We've over 3,000 clients at this point from all around Ireland, and we're adding to that on a daily basis. And we've currently under 120 million euro of assets under management, which we are adding to on a daily basis as well. And I think the key thing for us and maybe you and our potential clients is that we are an impartial company, which means that we're not a tied agent for any of the providers in the market. And why that's important, I suppose, is that we can seek out the most appropriate, the best performing, the most cost effective options in the Irish market for our clients without being restricted to, I suppose, certain providers. So as we know, today's webinar is going to be centered around tax reduction, and just some of the key takeaways or areas that I'm going to be focusing on is first availing of reliefs and allowances, just knowing what you can avail of and how to do it. I'm going to focus on claiming tax relief on retirement or pension contributions, and I'm going to move on to looking at tax back schemes such as the EIIAS scheme, the Employment Incentive Investment Scheme. We'll be looking at, I suppose, making sure that you are availing of all the tax reliefs that come on various protection products and just trying to structure your protection arrangements as tax efficiently as possible. And then finally, we'll be looking at, you know, tax planning and, you know, looking ahead and looking at ways for reducing inheritance tax and things like that. We will open it up at the end of the webinar to a Q&A, and my colleagues, Nick and Keenan, are on the webinar as well, and they'll be monitoring the chat box. So if anybody has some questions throughout the webinar, feel free to pop them into the chat box. But as I said, I'll give some time at the end as well for questions. So just to get straight into things, firstly on the release credits and allowances, I think it's really important for everybody to get into the habit of doing a tax return online each year and get into the habit of knowing what you can claim back on as to reduce your tax and put some money back into your pocket. Now, if anyone is familiar with doing a tax return online, you'll notice that there's a couple of different tabs and there'll be many different credits and reliefs that you can claim under all of these tabs. The main tabs are things like your health, your family, and your job. So if you look at things like health, the main ones there would be claiming back on medical expenses such as like GP visits and hospital visits and prescription fees and stuff like that, and certain dental treatment. So a good piece of advice there is to maybe just have a folder at home, and every time one of you visits the doctor or pays for a prescription, just pop in the receipt and you can claim all that back at the end of the year. So you get 20% coming back to you on the total cost of all those. I have health insurance noted here as well, but the providers actually apply the relief on health insurance policies at source in most cases now. And then you have things like paying for nursing home fees for relatives and things like that. Under your family, you can claim back on tuition fees. So if you're paying for your children's third level education, there are certain limits that you can claim back on, but anything over that you can. I believe for like full-time courses, it's anything over 3,000. For those of you who might be recently married as well, just make sure that when you are completing your tax return, you are registered on the system as being married, and just allowing you to claim back on the extra credits that gives. Under your job, then you have things like pension contributions, claiming back on your retirement contributions. Now that might be again at source through payroll, or maybe and might not be, but we'll get to more on that in a second. You things like flat rate expenses, claiming on income protection premiums, and something very relevant at the moment, obviously claiming back on working from home. If anyone is not familiar with claiming these reliefs online or doing a tax return online, this is just a snapshot of what the system looks like. So you'll see the tabs across the top. You basically just kind of work your way across them. You start with your personal details. If you are a PAYE individual, your main source of income should kind of automatically be there in the second section. Section 3 then is for inputting non-PAYE income. So like if you have, I suppose, an additional source of income, or maybe income from a rental property or something like that, it goes in section 3. And then you then move on to the main one here, which is tax credits and reliefs. And this is the way really to put more money back into your pocket and reduce how much tax you pay. Some of those, I suppose, areas that I mentioned in the previous slide, you can see them here, like health, your family, your job, and other credits. You can click the show more there and just go through them all and make sure that you are availing of everything that you can. You'll see there under myself, I've health expenses that I incurred last year to the tune of 447. So I was able to get 20% back on that. So there's about €110 thereabouts coming back to me. The two ones that I want to focus on under your job are claiming back as a remote worker and flat rate expenses, because I still come across people that don't know that you can do this. Obviously, I would probably say that the majority of the workforce now are, at least partly working from home. So it is important knowing about this type of relief, and it can be basically given in two ways. It is for any days that you have worked at home. If your employer is arranging it, it's automatically done for you, whereby they will give you a €3.20 credit per day directly through your pay. So you're claiming back there up to €768 per year. Now, it's worthwhile looking and making sure if your employer is doing that, because if they're not doing it, you have to do it yourself. And it works a bit different if you're doing it yourself. You have to basically, I suppose, find out how many days you're working from home, add up the total cost of your electricity, heating and internet costs, and apply the percentage of days you're working at home to the total cost of those bills. And you can now claim 30% back of all, the total annual cost of all of those through your tax return. So in most people's cases, that could be a couple €100 coming back to you. So really important that people are claiming that. It used to actually be 10%, whereas the government had increased it to 30% from last year onwards. So really, really valuable. The other one is flat rate expenses, which basically gives a credit or a rebate to people in certain occupations. So for example, people in certain trades might be able to get, €200, €300 as a flat rate expense to reimburse them for the costs of, I suppose, purchasing maybe equipment that they used during their trades. So just worthwhile, I suppose, looking on the revenue website and seeing if your occupation falls under any of these categories and seeing what you can claim under that. Now, the two, I suppose, slides previously looked at, credits and reliefs, which are claiming back tax in smaller portions, but there are other ways to claim tax back in I suppose, at much higher levels. The best way to significantly reduce how much tax you pay is to maximize the use of your pension. Now, there is a lot of confusion out there regarding exactly what a pension is, and that's, a fault of my industry because of, how complex they make pensions. We really overcomplicate them when in theory they're very, very simple. All they really are is just a long-term savings plan. And because of the tax benefits associated with them, they are the most effective way of saving money long-term and reducing tax. You can see down below here that revenue allows quite generous limits on how much you can put to a pension and claim tax back. So for those under 30, they can put 15% of their gross earnings to a pension, and that rises up to 40% for those who are 60 or over. So you can see it kind of goes up in increments of 5% every 5 to 10 years. How a pension works, as I said, is actually quite simple when you break it down. You and your employer pay into a fund regularly over the course of your career. You get tax relief on any contributions that go in from your side at 20% or 40%, depending on your income levels. Typically, anyone who earns under €37,000 pays tax at 20%, so they get 20% relief. Anyone who earns over €37,000 gets taxed at 40%, so they get 40% relief on their pension contributions. Now, some people might be carrying spouse's allowance, so it might, I suppose, work a bit differently for them, but generally that's how it would work. Now, the contributions are continuing to build up in your fund over time, and the key thing here is that any interest that's earned on those contributions is also tax-free, which really adds rocket fuel to your pension account if things are done right. At retirement, you get to access part of the final pot as a tax-free lump sum, and then the remaining value in the pot after taking that tax-free lump sum, you simply just draw down, I suppose, regular income from the remaining pot. In my mind, there's three reasons really that one would look to start the pension. The obvious one is replacing your income in your later years, and it's important to appreciate that statistically most of us will spend probably 20 to 30 years of our life in retirement. So rather than looking at it as an end point, it should really be looked at as, I suppose, a portion of our life. In some people's cases, it could be up to a third of your life. And that's why it's so important to plan ahead and making sure that there is provisions there to replace your income, even partially if you want to continue working part-time in your later years, if you have the option. Now, the state pension currently pays about €13,000 per year, just shy of that, currently payable from 66, and this is getting a lot of, I suppose, press coverage lately. But the reality is that the current state pension is not really sustainable. So I think it's very, very likely that by the time most people on this call are retired, that either the age will be pushed out somewhere between 68 and 70. Now, I could be swallowing my own words there. Maybe it will never happen, but I think it's quite likely. Or else what you'll see is that the benefit will be reduced. And I think that's really, that's why people should really look at putting private pension contributions in place in the event that the state pension doesn't give what it currently gives. The second one is to simply reduce how much tax you pay. If you want to pay more tax, don't start the pension. If you want to pay less tax, start the pension. It's as simple as that. Every €100 you pay into your pension will only cost you €60 as a top rate taxpayer, or €80 as a standard rate taxpayer. So essentially you're shaving €40 off your tax bill for each €100 you pay into a pension as a top rate taxpayer, or €20 off your tax bill for every 100 into the pension as a standard rate taxpayer. And as I mentioned earlier, those contributions grow tax-free, and you get to access a large portion of it as a tax-free lump sum. The third reason is it is the most effective way to grow money and accumulate wealth over time. So not only do you get the tax relief on the contributions, but you're getting decades and decades of tax-free compounding interest. So Albert Einstein famously referred to compound interest as the eighth wonder of the world. He said those who understand it earn it, those who don't pay it. So not only do pensions get, decades of compounding interest, they actually get decades of tax-free compounding interest. And that's why I said, that really does add rocket fuel to your pension account. And if you compare it to a normal savings account, it's going to come nowhere close to it. This just kind of lays out two scenarios of, I suppose, how pensions can affect someone's situation. So here you've two people, same age, earning the same level of income. You take Paula in this scenario, okay, she's earning €60,000 per year and she's not making pension contributions. So what she's actually taking home is €3,531 per month. Because she's not making pension contributions, she's losing over €13,000 per year to income tax, or €132,400 lost to income tax over the next 10 years to age 65. She's reliant then only on the state pension, which pays €13,000 per year at age 66, assuming that's still what it will be at that point in time. And the other thing is that if she decides to save or invest any of her after-tax take-home pay those investments are being taxed at 33% or 41%. In stark contrast, if you look at Jason, who's also 55, earning €60,000 per year, and he's going to contribute 20% of his gross earnings to a pension until age 65, he's coming out with €2,931 per month after tax. So he's taken the option to save €7,200 of his annual take-home pay. But what's actually hitting his pension account is €12,000 because of the tax relief. So he's giving up 7,200, yet there's 12,000 hitting the pension account. So he's essentially saving €4,800 per year in income tax, or 48 grand saved in income tax over the next 10 years to his retirement. Assuming a very, I suppose, conservative interest rate of 5% average per year, he's going to work up a fund value of €164,906 at age 65. He gets to take part of that as a tax-free lump sum, so 25% of the fund. So he's getting €41,227 as a tax-free lump sum at 65, and then he's going to draw down the remaining pot, which is about 124,000 here, as regular income to supplement what the state pension provides. A lot of people don't know you can do this, but you can actually reduce last year's tax by making a pension contribution and backdating it to the previous year, and including that online in your tax return for the previous year. So if you look at, last year, 2021, in this case, let's say you have €10,000 in a savings account that you don't foresee you needing over the next couple of years. You can make a transfer of that €10,000 into your pension account, and what type of pension you have, it doesn't make a difference. Even if you have a company pension scheme in the course of your employment, you can actually write a check or transfer 10,000 of personal funds into that pension, and you then go online and you do a tax return for 2021. So last year, you include the pension contribution in the tax return, and within a few days, revenue will kick you back €4,000 into your bank account on that €10,000 pension contribution, which makes the net cost of it just €6,000 as a top rate taxpayer. And the full 10,000 arrives into your pension, which grows tax-free to your retirement. A lot of times when I say this to people, they say it's too good to be true, and I can tell you now it's not. So you put 10,000 into your pension, which grows tax-free, and you get 4,000 back into your bank account. This slide is specific for, I suppose, company directors, but just bear with me. I speak to a lot of clients about, I suppose, trying to extract more wealth or extract more money from their company account. And if you have cash built up in your company account, the way I see it, you have three options to take this money, and it's about realizing what's the most tax efficient and the best way to operate things. So option A is to take it a salary or a bonus, whereby you're losing more than 50% of it to income tax, USC and PRSI, and the company is going to suffer employer PRSI to pay you that. So basically, if they're giving you, €10,000 as a bonus at the end of the year, it's going to cost the company over 11,000 to pay you that, and you're only going to come out with about 4,800 into your back pocket. Option B is to leave it in the company account, where it's going to lose 12.5% corporation tax, and the money is going to be sitting in a corporate bank account where it's going to be earning 0% interest or possibly a negative interest rate. Option C is to extract it out through a pension, where the full contribution will actually arrive in your pension, growing tax-free to your retirement. There's no income tax or BIK in your hands, and there's no employer PRSI or corporation tax in the company's hands. So it's a win-win, and pensions are, I suppose, the most effective way of trying to extract money out of a company for directors. I'm happy to discuss that in more detail with anyone who wants to explore it. The second scheme that I'm going to talk about to significantly reduce how much tax you suffer is a scheme called the Employment Incentive Investment Scheme, or EIIAS for short. It's basically a revenue-backed scheme which allows individuals to invest sums of money with qualifying Irish companies, typically over a 4 to 5 year period. And any amount of money that you invest with that company or companies, revenue will give you a 40% tax rebate on the investment amount as a top rate taxpayer, and you also get interest from the company for the use of your money over that 4 to 5 year period. Now, there's loads of companies every year that raise capital through this scheme, because for them it's a very cheap and efficient way of raising capital without giving up equity or control in their companies. And the incentive for us as investors is to I suppose, reduce their tax and generate a good return on investment. The reason the government and revenue support it is obviously to support progressive Irish companies and promote, employment and economic growth. But there's loads of companies every year that will look at this scheme to raise capital. There are some really early stage startup companies, which are obviously quite high risk, but there are some really solid established companies as well. Just to, I suppose, break things down in very simple terms, let's say you invested €10,000 this year in an EIIAS company. What happens is in next year, revenue will give you back 40% on that investment amount. So you get €4,000 coming back to you like a pension, making the net cost of the investment just €6,000. Assuming the investment is going to pay out in year 4 of the scheme, which is 2025, you get your initial €10,000 returned to you, plus an interest, which is generally in the region of 20 to 30%. In this case, I'm using an example of 28%. So you have 12,800 coming back to you in 4 years' time for an investment that had a net cost of just €6,000. There are very small fees to be paid on that investment as well, of about 2 to 3% over the entire course of it, which is a double your money scheme if things are done right. It's more than 100% return. So it's a really powerful scheme, and you can do it every single year. Typically, the minimum per company is about €5,000. So you put €5,000 into an EIS company this year, just in a couple of months' time, revenue are going to kick you €2,000 back. So you only have, say, 3,000 remaining in the scheme, or 3,000 at risk. One example of a company that I think is really strong in that space, and a company that is currently raising EIS capital, is Blacks of Kinsale, which are a beer and spirits company established in 2013. The company is currently valued at €15 million, and their revenue last year was over 2 million. So they are a very established and very solid company in my mind. And out of all the EIS companies that are raising capital in that space, I would say they're definitely in the top percentile. They have multi-awards for their products, which you can see here. And I think they are in a very supportive market. For those of you who don't know, Irish whiskey is currently the fastest growing spirit worldwide, and the craft beer market has exploded over the last couple of years. I'm sure a lot of you will start noticing that your local pubs have started replacing the Heineken and Budweiser taps with craft beer offerings. And I think it's in a really recession-proof market as well, because alcohol has always tended to sell well in good times and bad. The reason they're using the EIS funds is to build a new distillery and brewery in Kinsale to meet the increased demand for their products. There was a lot of press releases on that recently. That's an Echo article that you can see down on the right hand side there, giving some information on the planning permission being granted for the brewery and distillery, and they're paying investors a 28% capped return in addition to the tax relief for investments in this EIS option. We're happy to share more information with anybody who is interested in discussing it following the webinar. The next area that I want to move on to is, just as I said earlier, making sure that you're structuring your protection policies in the most tax efficient way possible. And the two policies I want to talk about are income protection and something called pension term assurance, which is effectively life cover. So income protection basically ensures a portion of your income each year, typically up to retirement, and it'll pay you a regular income in the event that you can't work due to sickness or injury. So it provides long-term protection. It's something that I believe absolutely everybody should have, whether your employer provides it for you or whether you take out a personal policy. It's really important to make sure that our incomes are insured, because our income is our most important asset at the end of the day. But income protection does allow up to 40% tax relief on the premiums. Now, I come across a lot of people that have something called specified illness cover. A lot of those people took out specified illness cover with the bank when they took their mortgage. They got it added onto their mortgage protection policy. And while specified illness cover is fine, it's important to note that it doesn't really provide long-term protection. And what I mean by that is that, God forbid, if a 30-year-old has a bad accident and they can never ever return to work, it doesn't really serve them very well getting a once-off €100,000 payout, because it's not going to last them very long. Whereas with income protection, it pays an ongoing annual income for any years that you can't work. The other thing about specified illness cover is it doesn't allow any tax relief on the premiums, so it can actually be more suitable and more cost effective to move your specified illness cover policy to an income protection policy, and we can review those policies for you to see if there's an area for you, an opportunity there for you to save, reduce your tax bill and get more adequate cover. Now, in some cases, people might wish to have or need to have both specified illness cover and income protection, but it is just, I suppose, another opportunity there for people to make sure that they are availing of all the reliefs on their protection policies. The other policy that I wanted to discuss is something called pension term assurance, which has nothing got to do with a pension, by the way. All it is a tax efficient life cover policy for people who are either self-employed or people in non-pensionable employment. So if you're working for an employer that doesn't have a company pension in place, so anyone who is in that cohort can affect this type of life cover policy. It's the exact same as regular life assurance in that it pays a lump sum on death to your dependents, but it actually allows you to claim back 20% or 40% on the premiums, similarly to the tax relief on pension contributions. For those who are company directors or company owners, they can put in place something called executive pension term assurance, whereby you basically get the company to pay for the premiums, and in the event of your death, it would pay a tax-free lump sum to your dependents. So it's just a really tax-efficient way of structuring things. And like the income protection and serious illness slide, it's about maybe reviewing your existing life cover policies to see if you can change over to a pension term assurance policy and claim tax relief on those premiums as a way to reduce your tax bill. I think that anyone who is self-employed or in non-pensionable employment probably shouldn't be paying life cover. They should be paying pension term insurance instead, which allows them to claim back on the premiums, whereas regular life insurance does not. The final thing I want to talk about from a tax reduction point of view is tax planning and looking ahead and looking at inheritance tax possibly for your dependents. So in Ireland, you may or may not suffer inheritance or gift tax on receiving money from somebody else, depending on the relationship and depending on the amount that you get. So we have 3 capital acquisitions tax-free thresholds in Ireland. For parents who are gifting money to their children, or their children is inheriting money from them, they can receive up to 335,000 over their lives. Now, that might seem like a big amount of money, but if you're a couple that owns a property in Dublin, which I shockingly found out earlier that the average house price is now more than €500,000, and you only have 1 child, that's going to be quite a hefty tax bill for them inheriting that property on your debt. For people that are in group 2, which includes things like, grandchildren, it's reduced at 32,500, and then any other person, it's €16,250. But there is another very powerful annual exemption against capital acquisitions tax that people have at their disposal, called the small gifts exemption. And it can be really powerful as a way to transfer wealth to your family members without eating into their capital acquisitions tax thresholds. Just to give an example of that, okay, let's take Louise here, who's inheriting 450,000 in an account from her mother on her debt. The funds were from the sale of a property 10 years before her debt. As Louise falls into the Group A threshold of 335,000 and she's inheriting 450,000, the balance of 115,000 is actually subject to capital acquisitions tax at 33%, which means that Louise has to pay nearly €38,000 in tax from receiving this amount of money from her mother on her debt. Now, there is something that her mother could have done to avoid this scenario, and it's something people can do as well for their own kids. So what if instead Louise's mother started to gradually transfer the money to Louise and her family 10 years before her debt, after she sold the property, using the small gift exemption? She could have gave €3,000 to Louise each year by 10 years, which is €30,000 passed on tax-free. She could have gave 3,000 to Louise's husband each year. That's another 30,000 tax-free. And assuming Louise had 2 kids, she could have gave 3,000 to each of the kids each year, which is €60,000, another €16,000 passed on to that family tax-free. That could have been put into accounts for their education, something we would usually, I suppose, structure for grandparents for their grandkids. So in this case, Louise's mother has actually passed €120,000 tax-free onto the family over a 10-year period, which would have left just €330,000 in the account inherited on debt, and no tax to be paid for Louise in this case, just with some careful planning, and she would have been left with €5,000 of the tax-free threshold unused. So it is important to just plan ahead and making sure that you I suppose your eyes are open to things like this. So just to summarize, some of the other areas that Alpha Wealth can explore with our clients outside of tax reduction is things like mortgage advice, reviewing existing mortgage protection arrangements to try save you money or helping you get onto the mortgage ladder. Protection reviews that I made a small reference to earlier, making sure that you're getting the best cost effective plans out there and I suppose the most tax efficient plans, things like pension and retirement planning advice, estate and succession planning, child savings plans, and the tax back schemes such as the EIIAS scheme. If anybody is interested in looking at all of the above, we do offer full financial planning consultations, and we find that we generally make or save clients thousands of euros in this process and ensure they're set up for the future just for a cost of €99 plus VAT. What it entails is we'll review your current financial situation and your plans. We'll then decide on some financial objectives and goals, which now that might be clearing a mortgage before I'm 55 or 60. It might be, planning for my kids' education or maybe retiring early. We'll then map out a cash flow model to project your future financial situation, see if there's any deficit, and we can then put a financial plan in place to help you achieve your financial goals, as well as identifying ways to save you money, reduce your tax, and make your money work harder for you. So if anyone is interested in exploring that a bit further or discussing it with us, you're more than welcome to reach out to us after the webinar, and my own contact details are there. So look, thanks for your time, everybody, and look, I'm happy to open up the webinar to some questions now if anybody wants to unmute their mic and ask a question. I hope you got benefit from that, by the way.